Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Tuesday, August, 28th, 2000, or maybe 27th. I'm not even sure what day it is. But anyway, welcome to the show today. Really appreciate you being here. I'm Tom Boley, Chief Market Strategist at earningsbeats.com. It's a pleasure to be back with all of you. Been a good last few days. Got away, got a nice vacation in. Really psyched to be back, though. Actually, I really missed the market I looked at almost nothing while I was away. Had my phone with me, so I checked some prices. Checked obviously the S&P 500 and kind of following along a little bit. But honestly, I'm catching up this morning. While I get ready for the pre-market action and all. So I can tell you. Let me pull this up for you. Bear with me. I'll get to the futures here. Had it up. Anyway, here we go. All right, so right now we got the futures up. Well, the diamonds track the Dow Jones up about 63 cents. That's up 0.15%. We've got the spider, which tracks the S&P 500, up about 0.1%. So it's back up above 570. We have the QQQs tracking the NASDAQ 100. That's up $1 or about 0.2%. And then the IWM, which I did notice last week, was still trying to get back through that 225 level. Got up there, failed, kind of pulled back. Transports pulled back. I think biotech's pulled back. Semiconductors still struggling a little bit. Just kind of getting back into all the action. But that's kind of some of the headlines that I saw. Anyway, the IWM, which tracks the Russell 2000, currently up about 1/3% this morning. So it's back to 221.50. But still got some work to do to get back up to that 225 area and to break back out again. Of course, the all-time high is up closer to 235 on the IWM. We'll take a look at that chart in just a little bit. But let's go ahead and jump in and take a look at the action from last week. So, or actually from yesterday. It seems like it's from last week for me. But yesterday we saw the Dow Jones Industrial Average jump 61 points. Not really that big a deal, but we now are over 42,000. We were trying to get through about that 41.6, 41.7 level last week before I left. So we've cleared that. The Dow Jones has broken out into all-time high territory since then. Really looking good. I mean, the Dow, the S&P, the NASDAQ 100, I think all, especially Dow and S&P. NASDAQ's bounced back nicely, but still got some room to go before breaking out again. S&P 500 was up 16 points yesterday. That was up a little more than 1/4%. NASDAQ gaining 25 points, but on a relative basis, slightly lower than both the Dow and the S&P, gaining just 0.14%. Going down to the small caps, and this is the S&P 600 small cap. It's not the same as the IWM, which tracks the Russell 2000, but it's another way to look at small caps. Small cap 600 was up just a fraction yesterday at the 1415 level. S&P 400 mid cap was up 0.5%, though. Did a lot better, actually best among our major indices, and that's back up now above 3,100. The NASDAQ 100 gaining about 0.3% back at 19.8. I think that'll high. We'll look at it in just a minute, but I thought it was around 20,600 or something, but I could be off for sure. Volatility index came down a little bit. It's back down below 16. Still kind of high, but still kind of bullish. I'd rather see the VIX down around 11 or 12, to be honest. But 16 or close to 16 still keeps it within that range of 17 to 20. So there's still some fear in the market, which is probably justified. We are still in the middle of the second worst week of the year. But all things considered, I think the bulls would absolutely take what we've gotten so far this week or during this week, which ends on Thursday. The really bearish part of September ends on Thursday at the close. But we still have October ahead, and we know that we've had a lot of declines and some big declines. Some major bottoms have formed in the month of October. If you recall, just last year, talked about it ahead of time and said the best time of the year was coming up. And on October 27th at the close, that date through January 18th at the close historically is the best time to be invested in the US stock market. That goes back 75 years. And if you recall, last year we closed, this was in 2023, but on October 27th, we closed at what would be the low. And then we took back off again. Remember, we had that cyclical, or not cyclical, bear market. We had a correction. I think it started in July or August, ran through October. That bottom printed on October 27th. Now, seasonality doesn't always work out quite that easy. And we're seeing it right now with this week in September historically being bearish, and we're really not seeing any bearish action at this point. But last year did actually hit right on the October 27th. The worst period of the year historically is from July 17th close through September 26th close. So actually, I think I got way ahead of myself saying the 27th or whatever, because 26th, I believe, is Thursday's close. So I think today must be the 24th. Anyway, that's how out of it I am right now. I don't even know where we are in the month. But anyhow, Thursday will end the period. That's going to be September 26th. That's the worst period of the year. A lot of people say go away in May. That's not the case. It's that July 17th close to the September 26th close. That is by far the worst period of the year. I got the numbers to back it up. It's not just my opinion. It is fact. And so, that period is about to come to a close for us. I mean, we've had a rough last couple of months, lots of ups, lots of downs, everything else. But that period, historical period, is about to end, which is good news for the bulls as we move into October. But still, there's this. I mean, if you go back the last 20 years, I think October has been one of the better months of the year. But historically, if you go back beyond the last 20 years, we know that there have been some rough Octobers. So I don't think we're out of the woods, but I really do like what the market's been doing. I mean, there was a lot on the market's plate last week with the Fed announcement. We had options expiring, historical bearish week kicking in, overbought conditions on some of our indices, and yet the market just kept going higher. Or at least held up pretty well. S&P 500 breaking above 5,700. I mean, all these things took place in what could have been a rough week based on what a lot of the signals were showing. So you got to give it up for the bulls. I mean, I think the bulls continue to show that this fight isn't over. And that's what I've talked about kind of down the road. I was nervous in the short term, but I've always maintained my stance that this market wants to go higher. We're going to be in the 6,000s, if not this quarter, then or probably in the first quarter of next year. And I'm talking about the S&P 500. So I would not be surprised if we had a really, really good year in 2025, possibly even better than what we've seen in 2024. But anyway, that's down the road. We got plenty of time to talk about that. So what happened yesterday? Well, there you have it from a index standpoint. Let's move over to the sectors. I'll kind of bring this up a little bit so you can kind of see it a little bit better here. But energy yesterday was the leading group, back up to 89. I remember before I left, I think energy was down back maybe somewhere in the mid 80s. And I thought energy could have a little bit of a run simply because we got down to some key support. The crude oil prices were so oversold. And anytime crude oil bounces, that's usually a good sign for the XLE. And so we have seen some of that, which is good. Consumer discretionary continues to be pretty strong. I know I saw Tesla really strengthening, moving out above some key resistance levels. Tesla now one of the better FANG stocks, in my opinion, the way it's broken out and the way it's setting up. Amazon's been doing well. Those are the two big leaders in consumer discretionary in the XLY. I don't know what the percentage is, but they probably make up 40% or so of the XLY. Then we had real estate, utilities, materials, industrials, had a lot of more value-oriented, dividend-paying type stocks that were leading on Friday. Down toward the bottom, you saw communication services and technology, more close to the flat line. And then bringing up the rear were financials and healthcare on Monday. Now, I'm going to go back the last 5 days, last week, because that's about how long I've been gone, not quite. Just to point out, energy has been the leader over the last week. Consumer discretionary, like I said, continues to do well. One ratio that I think is starting to show some really good signs is the XLY XLP. That's one of our sustainability ratios. That's been improving, which I like to see. You can just see from last week, consumer discretionary gaining 3.6%, consumer staples down 0.86%. So all of a sudden, we're seeing a little bit more rotation into the more aggressive discretionary group. And you have to remember that consumer spending is roughly 2/3 of our GDP. So where that money is being spent and where the market anticipates that it's going to be spent is really important. I think this is one of the most significant, what I like to call sustainability ratios out there. And I do, use different areas of the market, intermarket relationships to just give me a little bit better sense of what's going on underneath the market rather than just simply looking at the S&P 500. Because we all know if you've been following the market long enough, you can get some pretty not so great signals from the S&P. If you remember, beginning of 2022, S&P 500 was setting an all-time high. What's not to like? But we talked about Market Vision 2022, and that was the first or second week of January. We talked about the fact that it looked like the potential of a bear market ahead. So you can't just look on the surface at the S&P 500. You really need to follow some of the other signs. And quite honestly, some of them I think still are showing some struggles. And I'm going to try to get to that before the show ends today. Anyhow, looking at the sector strength over the last week or weakness, depending on how you look at it. Technology, of course, is one I like to keep an eye on. It was kind of middle of the pack. So it really wasn't leading the S&P 500, but it wasn't lagging like we had seen before. It's just kind of going along for the ride. So I think that's a pretty good. Down at the bottom, we had three of the defensive groups. We had real estate, consumer staples, and healthcare. And this is going back over the last week and since that Fed announcement came out. And of course, while I was gone, that was probably the biggest announcement of the week. I was surprised. I really thought that cutting rates 50 basis points would probably send the market lower. I thought that I was expecting them to do a quarter. I'm not so sure if 50 basis points wasn't the best answer. I just was thinking maybe the market may have taken it the wrong way, because anytime you start a cycle of interest rate cuts and you jump immediately to 50 basis points, that kind of gives you the scare that, oh my gosh, the economy's worse than maybe what I think it is, or it's going to get worse. But I think in this case, I think what the message the Fed was sending was inflation's dead. We're not worried about inflation anymore, which is what they probably should have been thinking a few months ago, but it is what it is. They finally came out at that Jackson Hole speech. We had Fed Chief Powell indicating that that they had changed directions, that their policy needed to adjust. And he certainly did that at the meeting, coming through with a 50 basis point reduction. I didn't really get into too much of what he had talked about in terms of how many we were going to get. I know that this is the start of a rate cutting campaign, and that's going to be good for the market if we have a soft landing, or even if we just have a mild recession. The fact that we're going back into a rate cutting mode tells me the economy by the middle part of next year is likely to be humming along, and the market anticipates that. Market's not going to wait to see it. It's not the way the market works. I mean, if you remember when the rate hike started, we were almost at a bottom before the Fed hiked that first 50 basis point hike. I think that was in May of 2022. We got that first 50 basis point hike. I don't remember how many 50 versus, but then I think we had a 75 or a couple 75s, whatever. We started hiking rates. But by the time we started those big rate hikes in May, most of the damage was already done in the stock market. We had gone from 4,800 down under 4,000. And in June, that's when I called the bottom in June of 2022, at pretty much at the beginning of those rate hikes. So it's not, and I get a lot of feedback. Some saying, well, you can't bet against the Fed, can't fight the Fed when they're raising rates. And then I have a whole different crew coming in and say, well, when rate cuts start, that's bad for the market. Well, not everything's bad for the market. Something's got to be good for the market. And lower rates generally, I mean, if everything else is ignored and you just talk about valuations, when interest rates come down, valuations should go up, period. It's just all the other things. Why are rates going down? How long will the cutting campaign last? If it's an economic issue, how much worse will the economy get? Those are all questions that send a lot of market participants into the more of the safe mode, the sell mode, which can trigger a cyclical bear market or maybe even a secular bear market. That's not the case here. We've still got an economy that's been pretty resilient. I mean, I'm watching the initial jobless claims. I think last week it was back down the 200 and teens. So the fact that we had gotten up close to 250, or maybe we hit 250,000, it's been a little while, but I think maybe we got up to about 250,000. We're back to the two teens. It's not morphed into a worse picture. It's gotten actually a little bit better. Jobs still remain positive. So this isn't a horrible market, and unemployment rate dropped back down. So that, which I expected with initial jobless claims cooling off. But that was this whole period and what we've been through and what we were kind of thinking might happen with the economy really hasn't happened. And as a result, the market's held up well. I mean, if you're telling me we're not going to have a recession, market's not going to go back down, not significantly. I mean, October can do its thing sometimes. Maybe we'll get one more pullback, but stock market looks poised to go higher, especially from a longer term perspective. All right, let's keep moving. Got a lot to go through, and it's already 9:15 Eastern. 10-year Treasury yield. So I hadn't really followed this too much. I know that the reaction to the Fed wasn't crazy. I mean, I still think we remain in a downtrend. We didn't get a huge drop after the Fed meeting, but I do think the overall downtrend remains. If we could break back up above about 392 or so, then that might kind of change things, and we might be in more of a uptrend from a short-term perspective, or maybe even into intermediate, because that would be taking out the recent high. It would also be taking out the 50-day moving average, which, if you look back during this downtrend, we've only seen that one time during this downtrend. We had one time where we went up one day where we closed above the 50-day. Next day, we came down to it, and then we were right back down below. And we've been in a clear downtrend. Can't call this an uptrend. It's been downtrending now for about 4 or 5 months. But if we were to get back up through the 391, 392 area, clear above that 50, and maybe get a couple closes above the 50, I think at that point, maybe things in the short term would start tilting a little bit more toward the bears as far as the treasuries itself goes, not the yield. Because remember, treasuries go down, yields go up. Always remember that relationship. Never a question. That is always the case 100% of the time. If you're selling bonds and bond prices are dropping, yields always go up. So if you're thinking about this being a bond market where maybe yields are back on the rise and folks are selling treasuries, that's what I'd be looking for initially. Move back through about 391, 392. We're not there at this point. All right, S&P 500. So this is what I was talking about. We hadn't gone through 5,700. Maybe I just needed to leave the country. I don't know, but we got through 5,700 last week. Did it on Thursday, Friday. I wouldn't exactly say we're running off to the races here. Intraday action's been pretty flat, but it's not exactly selling off either. So I just think, hey, it's a 52-week high. It's an all-time high. It's really hard to argue with that. I mean, I'm going to try with a couple charts, but for the most part, it's hard to argue with all-time highs and trying to claim bearish things. I mean, I did it in 2022, but we were in a much, much different situation, especially in sentiment. Back in 2022, the market was so bullish, incredibly bullish from a sentiment perspective. That is not the case right now, not from a long-term sentiment perspective. I haven't looked at the put-call ratio. I'll be looking at that a little bit today, later on. But that's something short-term that could give us a top versus bottoms. It's been pretty good at predicting tops and bottoms over the years, at least short-term tops and bottoms. But anyway, S&P 500, like I said, it's over 5,700. Look at the AD line. AD line continues to be fairly strong. That's another good sign for the market. Moving on to the NASDAQ 100, still not up where we were back in July. So on a relative basis, you can see that there's been a little bit of rotation away from the NASDAQ and into the S&P 500. And I can tell you with one word, pretty much the reason for it, and it's semiconductors. Semiconductors still, even with the market going up last week, they're struggling. Nvidia at 116, remember its high was up around 140, 141. So it's still got a long ways to go to get back to the upside. I think if that group starts to move, then we're going to start seeing some pretty big numbers taken out to the upside on the S&P 500 and on the NASDAQ. We'll move back to all-time highs when those semiconductors get going. Until they do, I think right now NASDAQ 100's got pretty decent resistance just below 20,000. That's where we were the last 3 days, just below that 20,000 level. We gapped up off of an uptrend. So we've got these 3 candles right now sitting on an island. I'm going to zero in so you can really see this. These 3 candles are sitting on an island right at resistance. Now, again, it looks like that we're going to start up today. QQQ right now is up 0.3%. So that would take us up, 60 points? So that would get us up to 19,910 maybe. I don't know exactly where we're going to open, but that might be a pretty good guess based on where the Qs are right now. Can we get, are we getting through this level? And I would maybe even, let me go back down here. I want to annotate this because there's a gap that we need to watch here too. And that is right. Oh, I thought I had that. Here we go. Right there. See where we gapped down back in July? Gapped down just above 20,000 and then made our way down. We got back up almost to 20,000, back down. Now we're up almost to 20,000. So I think we could even get up just slightly above 20,000 and possibly reverse on the NASDAQ. I think what we're going to need is some help from the semiconductors. If the semiconductors roll back over again, then I think we got some problems here. IWM, small caps. I'm still waiting for this group. Not going to lie, a little disappointed with how they've traded since the Fed meeting last week. I mean, we looked like we were going to move up, break out. We gapped up, but we had nothing after the gap. You can see these last 3 days, these are filled candles. So zero in again. I mean, we're closing below the opens. So this isn't good. We do have gap support here around 219. Hopefully we hold that. If not, watch that 20-day moving average. Actually, a test off the 20-day and then, break back out to a new high would be really bullish. But remember, this is not the all-time high on the IWM. That would come if we got back through, I think, 235. We got weekly 5-year chart right here. I can give you the number. Intraday, 235.46. And you can see back a couple weeks ago, we got to 228.63. So we got within 7 points of it. But going back to that daily chart, we haven't been able to close above that 225 area. So that's the one to watch for me anyway on the IWM. Transport's another failure. It looks like maybe we even had a slight breakout, kind of like what we did back in mid-July, a little bit of a false breakout, immediate selling again, but trying to turn back up. If once we get a definitive breakout here, and I think this goes back quite a ways, I'm going to pull up the monthly chart because you can see now since 2021, we have been battling in this area. We actually had 1 month back in November of 2021 where we got up to 18,246. That month we closed at 15,848. And let's see if on the weekly chart where we were. On the weekly chart, we closed at 16,843. So probably getting through 17,000 would be a big thing. But just short term, trying to get back up through about 16,500. Let me zero in here again on this weekly chart. Here's that 16,500 level. I mean, we're going back quite a ways. This would have been all the way back in July of last year. So probably about 15 months ago since we traded comfortably above 16,500. Of course, that one didn't last. So still a lot of work to do here. All right. For those of you who are new to earnings beats, first of all, we got some events coming up. We'll be announcing those very shortly. But we've got um, a couple of things that you need to be aware of, maybe would interest you. First of all, if you want to sign up for our paid service, we do have a 30-day free trial. You have to use credit card, but we're going to let you know before your 30 days expires. But check us out for 30 days. This would be a great 30-day period to do so, essentially getting you right almost to that October 27th, where we have that historical low. 30-day trial pretty much gets you through that October period. So I think it would be very worthwhile at this point in time. But if you just want to learn more about us, make sure you subscribe to our EB Digest. So just scroll down on our homepage. Again, that's earningsbeats.com, both plural. Name, email address. You'll get our EB Digest articles, which come out Mondays and Wednesdays. Just talking about a lot of the things that are important to us at Earnings Beats. So we're talking about a lot about relative strength, of course, price breakouts, breakdowns, earnings, gaps, trend lines, retests. I mean, all the things that most technical analysts and most technical traders are going to use. So if you want to just kind of get more, hopefully more knowledge, maybe add to what you already have, I think that would be a great way to do it. Again, that's free. There's no credit card required with that one. You can unsubscribe at any time. It's really just an opportunity for us to give back to the community that we serve. Anyhow, let's move on. Chart of the day. I wanted to go over Sienna because I saw Sienna made a big breakout last week above the September high. We now appear to be trending higher, and we got one big level on Sienna that we need to try to get through at $63. We are a little overbought, so maybe Sienna, when we get up to the 63 area, could have a little bit of struggle. That's where we were, several months ago. If we do get through 63, I think we could really move, although I would rather see it maybe with a cup, maybe get up to 63, pull back some kind of a bullish pattern, maybe some kind of a basing pattern, and then make the breakout. And I think that would be much, much more tradable. But anyway, Sienna was looking a lot better, so I wanted to point this out. And then I wanted to go through this chart. I was actually setting it up as the show was beginning. So let me finish this chart. But what I wanted to just show you was under the surface, some of the things that we like to follow. And this is how you set it up. So I'm going to zero in here, hopefully, so you can see it better. But I've already set up QQQ versus Spider, XLY versus the XLP. I talked about that earlier. That's discretionary versus staples. IWF, IWD, that's the Russell large cap growth versus Russell large cap value. So just giving you a little sense of what's going on with growth and value. Then I usually like to do another growth versus value. So I do the DJUS growth large cap versus value large cap. And then we come down here again. Let me get another one, because this one I normally do with the mid caps, growth versus value. Then I come in here with the small caps, growth versus value. And then I also sometimes will do the transports versus utilities. All right, now let's get the rest of the chart set up. I like to use the solid lines as opposed to candlesticks. Just gets rid of some of the noise. And I like to make it so that the size of the charts are big enough that I can actually read them. And then change the height so that the height of each panel is pretty good size. Actually, I'm going to go even higher. Let's try that out. All right, pretty good. So here's the big picture of the S&P 500. And you can see going up, this is the QQQ versus the Spider. This went up for a while, up through early July. When we reached that final high right there, you can see we were kind of trekking back down. So growth didn't lead that last push to the upside. It was actually value, or at least to some extent. XLY, XLP, you can see all year, really not great. But look at what's happening during this last move to the upside. As we move up, now you might say, yeah, but it hasn't taken out the prior highs. I generally look at this as a really big picture. So the S&P has been going up, well, since 2009. but 2013 is when it cleared the 2000 and 2007 high. So to me, that's when the new secular bull market was born in 2013. And the overall chart of the XLY XLP has been trending higher. It's just that if you look at it short term, you don't really get that, or down here, you really don't get that full picture. I just want to see it going up. When the market's going up, I want to see that money is rotating to discretionary, as long as big support levels haven't been lost, which long term they have not. So that one's looking a little bit better. QQQ Spider is strengthened, but it's still in that downtrend and still pretty close to its low. So, and that's what I mentioned earlier when I was looking at the NASDAQ 100, and I said it really hadn't been doing as well as the S&P or even the Dow. And that's what this chart right here is telling me. Still kind of hovering. This hasn't been a great rally on a relative basis. It's been okay, but still mired in a longer term downtrend. IWF, IWD. So now we're getting in these growth versus value relationships. Yes, we've strengthened this month in September. Have we taken out any key levels? Not really. And I'm going in as we get down. This is large cap growth versus value, mid cap growth versus value. Again, we bounced in September. Need a lot more out of this area. Small cap growth versus value, same thing, right? And then come down here, transports, utilities. Transport's still underperforming, down near 52-week low versus utilities. That needs to change. So we've still got some of these underneath the surface signals that aren't great. Still makes me a little cautious going into the latter part of September and into October. But again, long term, I'm not cautious. My long term signals remain very bullish. It's the short term. It's could we have another 5% move lower in October or late September? I think the question is absolutely yes, we could. Will we get it? I don't know. I think short term is really hard to call. I'm really confident about the long term and the market going higher. Short term, I just, anytime we're in this period of the year, especially when we're seeing growth not really performing well as the S&P is setting new highs, that has happened before. I'm not going to say that the market can't go up. Anytime we see financials and industrials generally outperforming technology and communication services, then that's a period when we could still move higher without the help of technology. I think it was 2013. I'm not going to look at it today. We're running out of time. But I think it was 2013 that the S&P 500 had a pretty good year, and technology on a relative basis was down. I think on an absolute basis, technology went up, but it wasn't leading. So it's nice to have technology leading because it tells you the market is risk on, which really gives you better feeling that it's going to continue going higher. But there are periods when technology might go up, but it just doesn't go up as much as the S&P 500. And typically when that happens is the fourth quarter. So, we still got the fourth quarter ahead. I still think financials, industrials, small caps, still expecting them to lead. We'll see what happens, day by day, week by week as we move through. I did want to change this, though, this chart. And I wanted to go back and look at the last 5 days and then do a 10-minute chart. And the reason I want to do this is I want to capture this same chart since the Fed meeting, because I always like to see whenever there's a big announcement, whether it's jobs report, the Fed. I mean, they kind of did something crazier than what most people thought. I think I was in the camp of the majority, thinking we were probably going to get a 25 basis point hike. Ended up getting 50. So when that happens, I like to see market reaction, not so much the S&P 500, but the intermarket relationships. So that's why I wanted to change this and look at this exact same chart, but only over 5 days. And this is where we are. So the market's opened. We gapped up. We've kind of come back down again. So over the last 4 days, I mean, this was the Fed announcement. So we went up, we came down, we went up, we came down. I mean, kind of like what we normally get after a Fed announcement, a lot of, back and forth, knee-jerk reactions, very volatile. and we finished on the low. And when I saw that with them doing 50 basis points, I really was more bearish short term last week when that happened. But then the next day we got the big gap up. Looked like everything was good, but we really haven't added on. That's what I was talking about when I was looking at the island. Perhaps an island cluster reversal, but that's going to require a gap down at some point. Anyhow, right now you can see S&P 500 last 3 days sideways, maybe toward the upper end of the range because we just got up close to that 57.35 or whatever it was, all-time high. Got close to it this morning, now reversing back down. I look at the QQQ and I see it kind of in the middle of the range right now, similar to the overall S&P. I do see the XLY, and this is what I've been talking about. We are seeing strength in discretionary versus staples. This is a really good signal for the market. And I really like this, telling me more about the long term than it really is about the short term, because it's making this move and it's been consistent now for several weeks, whereas the others haven't been quite as strong. The other signals you can see even now, growth, large cap growth versus large cap value is sitting near a 3-day low. So yes, it's up from where we were at the Fed meeting, but it is not really built. It's not leading the market over these last 3 days. It's actually been lagging. And you look at the large cap growth versus large cap value, it's just a different look, but pretty much the same results, as you can see. We're looking at the same asset classes, basically. And then you go to the growth mid cap, and you can see we've now moved to the lowest low over the last 3 days. Small caps rolling back over, not really showing us a whole lot today, but doing worse than the S&P. And then here's transports and utilities up today, but down since the Fed meeting. So I look at all this, and I mean, I like seeing all-time highs, don't get me wrong. But I don't really think the chart in the short term is screaming at me that we're going to just, fly from here. So my gut reaction, and we're going to wrap this up, but my gut reaction would be, based on this, I'm still a little nervous about the short term. Long term, if you're a long-term buy and holder or investor, I'm fine being in this market. If it goes back down a little bit again in October, so be it. I would have never gotten out of the market, period. If I was from a long-term buy and hold, I would just stay in the market. And I would continue that unless we get something like 2022, where we start talking about the potential of a cyclical bear market. That would maybe be somewhat of a signal from a long-term perspective. I mean, nobody wants to ride the market down 20, 30%. And so if you start seeing those kinds of signals, you at least want to be on alert. Maybe you take half off, and if it does something, you take the rest off, something like that. But what we're in right now, I don't think is a long-term issue at all. I think it's trying. I said back in July, August, that I just wanted a bridge. I just want a bridge to the latter part of October, early November, when the market historically does much better. Let us get through this period. We got the other thing I didn't mention was the presidential election cycle historically being bad. Markets kind of ignoring that right now, setting all-time highs. So let's see short term again, end of September into October. A couple of events coming up that we're going to talk about the history of these 2 months, especially October. I think you're going to want to mark your calendars, be listening, because this event is going to be coming up pretty soon. But we want to take a look at it just so everybody out there is educated, just so you know what you might expect over the next few, 3-4 weeks prior to it actually happening. All right, let's get a quick update on the market, and then we'll wrap this up. Sorry to take you 10 minutes late here, but did miss several days, so I wanted to kind of go through things, not just for you all, but for me. Take a look and see what's going on. So we've got a lot of green. Small caps look like they're doing better than the other areas of the market. The VIX is down about 0.75%, down at 1577. So all in all, I think the market continues to do pretty well. Let's see what happens the rest of the day. Again, today's Tuesday. This current period that we're in, short term, from last Thursday's close to this Thursday's close, is the second worst week of the year historically. We've been doing fine so far, but we got 3 more days. We got today, tomorrow, and Thursday to get through. So just at least have your radar detector out there, at least watching for a potential signal that the market's rolling back over. But that's it for me. I'm really glad to be back. Thanks to all of you for being patient while I took some time off. I really enjoyed. Kind of feel like I got my batteries recharged, which was always good. And looking forward to calling the fourth quarter as we see it. Have a great day, everybody. Happy trading.